Welcome back to the road to $100. This is an active, real money experiment testing the mathematical limits of automated trading strategies, not the theoretical backtest running on paper. This chart shows where the account stands today. The blue balance line holds at $2,147, while the purple equity line sits lower. Moving to the monthly table, the system carries a negative $323 total for 2026, putting lifetime growth squarely in the red. This status gauge highlights high severity of the historical losses we are working out of. The max drawdown metric confirms the account has survived a 33.13% drop in equity. Most trading channels only publish curated highlight reels of winning streaks. We document these sustained periods of drawdown in real time to show what holding a mechanized system through a losing quarter actually requires. Looking at week 28, this graphic shows an absolute zero across the board, 0 closed trades, and exactly 0% gain. The inactivity is total. Flanking the central circle, no swaps, dividends, or commissions were processed during the entire 5-day window. The terminal interface confirms this with a blank file folder icon, marking a complete absence of data for the week. During a drawdown, pressure to recover capital leads traders to poor setups. An algorithmic system removes that variable, remaining flat until strict conditions are met. This refusal to trade is a deliberate part of the strategy's design. It ensures that the current drawdown is not worsened by market participation that falls outside the system's logic. The GoldMining Loonie strategy operates strictly on the US dollar to Canadian dollar currency pair. In week 28, that specific market became highly unpredictable. A sudden release of US Non-Farm Payroll data forced institutional traders to rapidly adjust their interest rate expectations for the Federal Reserve. Simultaneously, conflicting domestic employment reports inside Canada drove aggressive speculation regarding future policy shifts at the Bank of Canada. To complicate the pricing further, wild fluctuations in global energy markets began heavily impacting the Canadian dollar's baseline valuation. 3 independent economic events converged in the same 5-day window. The resulting price action created an environment too chaotic for a risk-averse system to reliably calculate an entry point. This 15-minute chart shows how macroeconomic noise translated into raw market data. You can see an aggressive downward drop in price, leading to a weekly low on July 10th. Immediately following that bottom, indicated by the blue arrow, the market violently spiked upward. We call this unconfirmed volatility. The price is swinging wildly, but it repeatedly fails to touch the strict mathematical boundaries required to trigger an algorithmic entry signal. A manual trader would see large moves and attempt to buy the dip, only to get caught in these erratic, unpredictable reversals. Heavy market movement does not equal a safe trading opportunity. If the underlying statistical probability of a successful outcome remains low, the sheer size of the price swing is irrelevant. This chart shows the algorithm's direct response to that unconfirmed volatility. A flat, unbroken red line spans the entire week, representing 0% drawdown. Referencing the deposit load chart, the gray shaded area also confirms an absolute 0% market exposure. The system kept capital entirely out of the market. This highlights a counterintuitive aspect of algorithmic logic. Sometimes the most active, deliberate decision a trading system makes is the decision to do absolutely nothing. Holding cash carries a 100% survival rate. Forcing a position into the middle of a macroeconomic storm carries a high probability of realizing a loss. Maintaining a 0% deposit load through a period of high volatility protects the account from unnecessary exposure. Capital preservation remains the primary constraint for any automated trading strategy intended to last for years. Accepting a week of no activity keeps the account positioned for high probability setups when market conditions stabilize. In a process measured across years, weeks without activity are expected components of the risk management cycle. The drawdown persists, but the logic is holding. The transparency of the Road to $100 challenge remains intact, and the experiment continues.